In this video, we will walk through, in practical terms, how to file taxes as a sole proprietor in Denmark, so you can approach the process with clarity, confidence, and compliance. Operating as a sole proprietor, or enkeltmannsvirksomhed, means that you and your business are treated as one and the same for tax purposes, and your business income is taxed as personal income through the Danish tax system. The process starts well before you actually file your tax return, so the first critical step is ensuring that your business is correctly registered. You will typically have set up your sole proprietorship via forskudsopgørelse, where you obtain a CVR number if required, and ensure your registration with SKAT, the Danish tax agency. At that stage, you indicate whether you expect to have VAT-liable activities and whether you anticipate paying labor market contributions and income tax on business profits. Once registered, the backbone of successful tax filing is disciplined record keeping. Throughout the year, you should maintain detailed and accurate records of all income and expenses linked to your business activity. This includes invoices issued to clients, receipts for purchases, bank statements, mileage logs if you use your car for business, and documentation related to home office or other deductible costs. Using accounting software that aligns with Danish standards or a structured spreadsheet system will make your annual reporting much more straightforward, and it will also support you in case SKAT requests documentation. As a sole proprietor in Denmark, you are taxed on your business profit, which is your revenue minus allowable business expenses. Allowable expenses typically include direct costs for delivering your services or products, such as materials, professional tools, software subscriptions, and a proportionate share of costs like telephone, internet, and home office, provided they are used for business and properly documented. Salary to yourself is not a business expense in a sole proprietorship, since profit is considered your personal income. It is important to distinguish clearly between private and business expenses. Where there is mixed use, only the business-related portion can be deducted, and you should be able to justify the split if needed. In addition to income tax, you will generally be liable for the mandatory labor market contribution, AM-bidrag, which is calculated as a percentage of your business income before personal tax. You may also need to handle VAT, or MOMS, if your annual turnover exceeds the current registration threshold, or if you have voluntarily registered for VAT. If you are VAT registered, you must charge VAT on your sales and regularly report and pay this to SKAT, offset by the VAT you have paid on eligible business purchases. While VAT reporting is separate from income tax filing, it is a critical part of your overall tax responsibilities as a sole proprietor, and must be managed on an ongoing basis, usually monthly, quarterly, or semi-annually, depending on your registration. When it comes to the actual filing, the central tool is your annual tax return through TasteSelv on SKAT.dk. Typically, SKAT pre-populates parts of your personal tax information, such as salary income, interest, and certain deductions. But as a sole proprietor, you are responsible for providing the detailed figures for your business income and expenses. You will normally do this by completing the relevant business tax fields, often referred to as the udvidet selvangivelse, or extended tax return, where you report your business profit, specify certain deduction types, and confirm your chosen taxation scheme. Many sole proprietors use the business taxation scheme known as virksomhedsordningen, or the kapitalafkastordning, while others stay with the standard personal income taxation of business profits. Each scheme has implications for how you deduct interest, how you can retain profit in the business, and how your overall tax burden is structured. If your business generates significant profit, or if you have loans and interest expenses tied to your activity, it can be valuable to discuss the choice of scheme with a professional accountant to optimize your tax position within the legal framework. The filing deadline for individual taxpayers, including sole proprietors, is typically later than for standard employees, but you should always check the current year's deadlines on SKAT.dk, as they can be adjusted and may differ depending on whether you file digitally and whether you have complex business income. Missing deadlines can lead to penalties or interest charges, so it is best practice to collect your financial data early, reconcile your accounts for the year, and start the filing process well ahead of the cutoff date. As you prepare your return, ensure that your bookkeeping for the year is fully updated. Match invoices to payments, reconcile bank transactions, verify that all expenses are categorized correctly, and ensure that any asset purchases, such as equipment or machinery, are treated consistently, including any depreciation rules that may apply. Once your accounts are in order and you have calculated your taxable profit, you enter those figures in TasteSelv, review your total tax, AM by drag, and any preliminary tax payments you have already made, and then submit your return electronically. It is wise to save a copy of your completed return, export or back up your bookkeeping data, and keep all supporting documentation for the statutory retention period, in case SKAT later requests verification. Tax planning should also be forward-looking. As a sole proprietor in Denmark, you can adjust your preliminary tax, forskudsopgørelse, during the year if your expected income changes materially. If you see your business growing or contracting compared with your initial estimates, updating your preliminary assessment reduces the risk of large additional tax bills or significant refunds when the final tax is calculated. This is done through TasteSelv and only requires that you update your expected business profit and any other relevant income or deductions. Being proactive in this way smooths your cash flow and makes your tax position more predictable. Finally, while the Danish tax system is relatively transparent and well documented, individual situations can vary, particularly if you have cross-border activities, multiple income streams, employees, or significant investments. In these cases, engaging a state-authorized public accountant or tax advisor who understands both the letter and the practice of Danish tax law can be a sound investment that reduces risk and often results in net savings. To recap, filing taxes as a sole proprietor in Denmark rests on a clear sequence. Register your business correctly, keep structured records throughout the year, distinguish rigorously between business and private expenses, manage VAT and labor market contributions where applicable, choose and apply the appropriate business taxation scheme, file accurately and on time via TasteSelv, and update your preliminary tax as your circumstances evolve. By approaching each of these steps systematically, you transform the annual tax filing from a stressful obligation into a manageable, repeatable process that supports the long-term credibility and financial health of your business.